I don't think this is the top, and then we're going to fall down like we did in 2011, and then another 4 year bear market, and then it took us another five, six,
Yeah.
7 years to go. I don't think that's where we are because so the gold to silver ratio hasn't gotten anywhere near 40 to 1, let alone 30 or 15. In 2011, the gold to silver ratio was plummeting as silver made a final high in April, May 2011 to $50 then, but then the gold to silver ratio went down to about 30 to 1 now, and we're not seeing any of that. We're seeing both gold and silver pretty much go vertical almost at the same pace. Silver's going a little bit faster, but
Yeah.
not noticeably faster.
Gold confiscation, silver bottlenecks, and hidden wholesale trades beneath the surface of everyday headlines. According to precious metals analyst Rafi Farber, the precious metals market tells a deeper story. Rafi emphasized that governments have historically confiscated gold to maintain centralized control over credit and extend the lifespan of inflation. While this strategy can work for a time, he argued that such control always breaks down eventually, reaffirming the role of precious metals as a safeguard against fiat manipulation and systemic decay. Gold, in his view, remains a timeless anchor of monetary stability, immune to the distortions of state power. Rafi Farber also highlighted the structural fragility within the silver market, pointing to the recent bottlenecks in the U.S. refining system. He explained that while many individuals attempt to sell silverware heirlooms or coins to shops, refiners are too backed up to process the flow, creating a clog. This paradox, plenty of physical silver at hand but no way to refine it, reveals how demand can surge faster than infrastructure can respond. Rafi Farber further clarified that what most people witness, small-scale silver transactions at coin shops, represents only the visible tip of the market. The true weight lies in wholesale activity, where large 5,000-ounce bars move quietly between banks, family offices, and billionaires. Unlike the retail layer, this deeper market operates with little publicity yet has the greatest influence over price and liquidity. These observations show how both gold and silver expose the vulnerabilities of centralized fiat systems while standing as resilient alternatives in times of financial stress. If you found this video helpful, don't forget to like and subscribe to stay updated. We'll continue delivering sharp insights and expert perspectives on the forces driving gold, silver, and the broader financial landscape. Thanks for watching.
Well, you confiscate gold to control credit because if money is centralized, then you have more control over the credit until it doesn't work anymore. So it just extends the life of inflation. But I find it very encouraging that there's a campaign on X against gold by crypto, because that means that they care about this and they're worried about it.
Yeah.
That
I know.
reveals a lot. Yeah, but that's not really a crime.
No.
Yeah, so insider trading, it's perceived as a crime, but it's not.
Yeah.
It shouldn't be a crime, and it's not actually a crime.
It never
Um,
used to be, Rocky. Yeah. Sorry. Go ahead.
yeah, yeah. So I mean, this is a big libertarian point that if insider trade, if we stop prosecuting for insider trading, then people can look at actual moves, and then the information filters down. I mean, you're never going to get rid of the advantage that the rich have if they have more money to move the markets, and they usually have the information first because they're more well connected in the business world. I mean, there's no such thing as fair information or telling everyone all at the same time, unless nobody has any privacy with anything they say. So there's no reason to prosecute anyone for any insider trading. It's fine. And the less we prosecute it, the less valuable it will be. Because now when somebody really gets away with it, he makes a lot of money. Yeah, I don't want to make predictions on exactly how it's going to look, because I honestly, I don't know. I mean, I try to think that it's going to be more positive than negative, because I see the world we're in now, and I see the trajectory that it's taking because of the inflation. So I'd rather not go to where they want to take us, which is complete surveillance, complete state power. Everybody's signing up to WHO treaties so that the next medical event, whatever it may be or not, then we're all put in concentration camps. That's what they wanted to do last time. That's what they're trying to do now. So I don't want to be there. So any other alternative is better. So let's go through a little bit of hardship maybe, and maybe the weak are going to have trouble, and those who don't have actual money are going to be in trouble. But it's going to be better for them to be in trouble now than for them to be in a camp because of some cold that escapes some lab in, a year or two or whatever they're planning up. I don't know, some kind of permutation of that. So I'm glad to not be on the road that they want me to be on. Throughout the United States, they have extra silver somewhere. They have silverware. They have whatever cups or whatever heirlooms that they might, and they're trying to sell it. They're trying to dump it in coin shops, and a lot of them are refusing to take silver because they can't pass it along to the refiners to melt down because there's a clog somewhere. So there are a lot of willing sellers, but the refiners are filled. They can't handle any more products. So there's some kind of disjointing here, and the question is who's bidding the price up. If they can't get the silver, the people willing to sell it, then what happens from here? I mean, this is one of the symptoms of the fact that silver demand can come back into the public consciousness so quickly that the market, as it's structured for these current prices, can't handle where we are now, and then it results in a clog. That's what's happening.
Yeah.
And how much of the market really is that? I don't think it's that much. It's just the part that we see because it's the sector of the market that we're the most interested in and that we're a part of. And so we hear more about that. But like the people that are trading 5,000-ounce bars here and there, big banks or family offices or billionaires, they're not going to tell us what they're doing. They're not going to interview about it. It's not going to be on the mainstream media. So whatever is happening in the silver market is happening at the much bigger wholesale level than a few people that are, digging up some silverware and sending it to their local coin shop and getting rejected.
Yeah.
Okay, well, the latest is we're still over 100%, meaning there are more repo trades being made every night. I think the last number was was over 3 trillion. Then there are reserves that exist in the banking system. I think that's 2.98 or 2.88 trillion, whatever it is. There's more volume being traded every night than reserves that exist. Now, I've been looking into reasons how this is possible, and the closest I can get to an answer is that there's central clearing. So if two parties are trading, or a circle of parties are trading repo to each other, and you have a central clearing mechanism that cancels out repo debts from one bank to another, and so if one bank owes 50 billion and then the other bank owes them 70 billion back, only 20 billion will actually change hands, whereas 120 billion will be recorded as trading volume. I don't know how much of the volume is cleared, but what I can say is that I don't think there's that much room left, because we still see the repo rate getting squeezed higher. I think the last one was 4.3, and the Fed's upper bound is 4.25. So we're already out of the Fed's range, and that has to do with corporate tax day that was on October 15th. And on corporate tax day, a lot of money gets sucked into the treasury, so there's fewer dollars to trade in the repo market. But we wouldn't be trading above the Fed's upper target if the repo market weren't already tight. How tight can it get? Can we get to 110, 120%? Maybe, but we're close to something bad. It's just going to take a little bit more time than I thought, but gold's at 4,300, 4,250, so why am I complaining?
Rafi Farber connected stresses in the financial system with the behavior of precious metals, pointing to the repo market as a key warning sign. With nightly repo trades exceeding available reserves and rates already creeping above the Fed's upper bound, he argued that liquidity is tightening and systemic pressure is mounting. Even though volumes could stretch further, perhaps to 110% or 120% of reserves, this strain signals underlying fragility. Against that backdrop, the continued strength of gold above $4,300 reinforces his view that metals are acting as a refuge while the cracks in fiat markets widen. At the same time, Farber dismissed the notion that today's rally mirrors the 2011 cycle. Unlike the blow-off top in silver that drove the gold-to-silver ratio down to 30-1, both metals are now rising steadily together, keeping the ratio around 80-1. He further pointed to the unusual rise in open interest during a recent silver pullback as evidence that new positions are being built rather than liquidated. Taken together, these signals suggest the market is still in the middle of its upward trajectory rather than nearing an end, with gold and silver gaining strength in parallel to the stresses unfolding in traditional credit markets. Let's get back to the interview.
Well, that would mean that there's not enough money to borrow between the banks.
Yeah.
The repo is a standard feature of the Fed's daily monetary activities before COVID, and it was much more than a $6 or $8 billion a day. So it's still not that much, but I remember reading a few articles explaining why the standing repo facility can't help most banks. I forgot what the technical reasons are, but you have to be a certain type of bank to be able to use the standing repo facility. So if you're like a regional bank that doesn't have direct access to the Fed because you're too small, then the standing repo facility is not going to help you. But it's DAFCA, specifically the smaller regional banks that would have the most trouble, and they need the most access to the Fed, but they specifically don't have it. So the standing
Yeah.
repo facility is pretty useless in
Yeah.
saving smaller banks, which could start a chain reaction. So really, the standing repo facility is irrelevant. It doesn't even matter. That's good. Birch Gold, though, has a lot of shady dealings in numismatics. So sometimes they try to upsell people to the fake numismatic coins. Not exactly that they're fake, but I think Andy Shechtman told me basically how it works. Like you buy a die, and it's an exclusive sort of coin, and then you have the rights to the die. So then you stamp like a limited amount of this limited edition coin that supposedly has numismatic value, but it's not old or anything, and it's not even official. It's just a die that you happen to buy from some die maker, and then you just pump up the premiums that way. I've even gotten some calls in Israel from people that I like, people that are also believe in sound money. And they're like, Ravi, do you want to participate in this thing? There's this company in Ethiopia that's making these gold medallions for $11,000 an ounce. I'm like, no, I don't want to be any part of that. No,
No.
especially when we get to the panic phase, which is why I don't think we're over with this rally yet. We
Yeah.
could pause for a month or two or three or whatever it's going to be.
Yeah.
But I don't think this is the top, and then we're going to fall down like we did in 2011, and then another 4-year bear market, and then it took us another 5, 6,
Yeah.
7 years to go. I don't think that's where we are because so the gold to silver ratio hasn't gotten anywhere near 40 to 1, let alone 30 or 15. In 2011, the gold to silver ratio was plummeting as silver made a final high in April, May 2011 to $50 then. But then the gold to silver ratio went down to about 30 to 1 now. And we're not seeing any of that. We're seeing both gold and silver pretty much go vertical almost at the same pace. Silver's going a little bit faster, but
Yeah.
not noticeably faster. I also
think-
noticed yesterday and Friday, on not yesterday, but the last trading day, that open interest in gold and silver both went up on Friday. And usually, if this is the end of a move, on a move down like this of 6-7% in silver, you'd usually see the open interest fall as the shorts cover and
Yeah.
the longs exit, but that's not happening. We should buy capital with our gold and silver because that's what our responsibility will be. If prices are so crazy cheap that you can get buildings for 10, 15 ounces of gold, you got to do it because no one else is going to save the capital if it's not going to be us.
Gold and silver serve not only as a means of preserving wealth, but also as a safeguard against distortions created by government control and central bank policies. Risks from manipulative practices in the precious metals space further complicate the landscape, making signals such as open interest and the gold-to-silver ratio crucial indicators to watch. Panic phases have the potential to dramatically reshape valuations, reinforcing the idea that precious metals stand as both protection from inflation and systemic breakdown, and as a vital source of capital for preserving and rebuilding productive assets when fiat systems fail. How might the transition from holding precious metals as a defensive store of value to using them as active capital reshape the broader economy during a systemic crisis? So, stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support, and we hope you enjoy the video.